Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I am your co-host, Jared Lee.
And I'm Ben Rose. Here we are, brought to you live from, well, not actually live for you, presumably.
It's live for us.
Live for us. Brought to you at a time convenient to you from wherever you are, on whatever device you're listening on. To us. There should have been a to us somewhere in that sentence.
Yeah.
Anyway.
That's weird. Like, it'd be fun to get a snapshot of where people are, what people are doing when they listen to our podcast. I know we have one person who does it in the they put like we're their shower podcast. Chris.
Hang on, what? How do you listen to a podcast in the shower? Firstly, showers are noisy, and secondly, wet, which is
I can only assume
risky.
he's got some sort of high-tech audio situation in his bathroom.
Waterproof speaker system.
Yeah. Someone else is in an overly crowded, overly hot London Tube network.
Yeah.
Apologize to you, sir.
Somebody making dinner.
Yeah.
I did meet somebody the other day who came up to me and hugged me and said, I listen to your voice every night before I go to sleep.
She's like, I make it through the first intro. I barely make it through the tangent. By the time you're done rambling, I'm well asleep.
Yeah. Apparently we're being played as sort of background content in some lifts or elevators. That's
I would love that if you went into
massage parlors, waiting rooms at dentists, world around.
Yeah, yeah. That would be very funny. There was
royalty-free content. Are we royalty-free? No, we're not royalty-free. I'm being told if you use this content in a public setting without our permission, then you do so at your own risk.
Yeah.
And we probably don't have the resources to come after you. But
we probably don't really care that much.
Probably
either.
Very flattered.
If you're broadcasting us at your cafe, it's a very niche cafe.
Oh, but if there was a reinsurance cafe, that would be cool. You could actually use it for brokers and underwriters to meet, and then they could gradually establish a system of etiquette that becomes.
We would exclusively sell your wholemeal vegan blueberry croissants.
I hope so.
That's
I would expect
the only item that we sell at this cafe.
And we could call it Floyd's. Gradually, it would gain a reputation as the centre for complex reinsurance risks, and eventually get some special licenses that mean we can't be sued and can't. Be replaced. Anyway,
this possibly one of our strongest tangents to start an episode in a long while.
Certainly longest.
But I thought we would sort of going through the recaps of 1-1s and 1-4s and 1-7s all now behind us. We've been sort of engaging with people around the market, and the big points of questions, especially the younger audience is asking, is like, how can rates just jump as much as they do? Like 20, 30, 40% year-over-year rate increases. And I thought it might be interesting for us to spend a bit of time kind of identifying, like, how can that happen, right? Like, it's broadly the same risk and the same client, but a 40% uplift on their spend is huge. Right? Again, we've talked like a client spending $500 million in a year, like a 40% uplift is moving numbers quite a lot if that's what's happening.
And it's funny, isn't it? Because we are working... we're often finding these trends in classes of business which are relatively commoditized and have a pretty large amount of historical data associated with them. Right? So it shouldn't really be the case that between the year 2020 and 2021, for example, the data set of how frequently did hurricanes happen was suddenly changed forever in terms of, how many hurricanes happened and how frequently. Like, even if you had a massive hurricane in 2021, if you've got hurricane data since 1900, then no biggie, right? The probability of a hurricane is still pretty similar. But as you said, somehow it's like, oh, no, it's actually half the times more likely. So we thought we'd dive into why that actually does happen and does weirdly make sense. For our market, at least.
Yeah, so we'll touch on kind of the broader market cycles. We'll talk about sort of capacity constraints and other types of things. But let's start there with the cyclical nature of reinsurance markets. And for many listeners, they may have only ever experienced a soft market, right, where capacity continued to come in and general supply and demand economics meant that pricing was gradually coming down, and it was pretty expected that the deal you're going to write this year would be a few percentage points cheaper than what you bought it for last year. And that was just the way the market was sort of continuing. And there was the old guys in the corner of the office shouting about the hard markets that they'd experienced before, but for a couple decades, we didn't really have one besides a couple classes following maybe 9/11 or something, right? And that's beginning to change now.
Yeah, and there's probably some listeners sat there thinking, I finally beginning to understand through the magical edutainment of the Reinsurance podcast that the hard market is not just an Instagram account that I should follow.
You should follow it, though. If you have Instagram, the hard market is very, very clever. Yeah.
But anyway, yeah, so this concept, as Jared said, of soft markets and hard markets, primarily driven, I would say, by capacity constraints, right? So we had a prolonged soft market cycle for a number of years, largely tied into interest rates. So it was very difficult for pools of capital in general to earn substantial returns and to diversify away from traditional assets. And so for quite a long period of time, insurance as an asset class, the risk of bad stuff happening was seen as quite unrelated to other investments and therefore quite a nice diversifier.
Non-correlating for those.
Non-correlating, exactly. And equally, one which in some cases promised quite good returns, that were better than, completely zero interest rates in some cases, or even negative in some areas, right? So if you could put your money into insurance, that was actually quite attractive as an alternative. The result being that we had loads and loads of reinsurance capacity available in the market, loads of insurance capacity, new firms popping up all the time, and that made it a very competitive market. So people basically trying to undercut each other in order to get access to business. Very, very hungry mouths, all wanting a share of everybody's reinsurance program. And as a result, brokers having a field day when it came to placing a deal and almost outcompeting each other. Again, brokers popping up everywhere and saying, use us, we'll be able to save you, 50% on your reinsurance spend by gradually pressuring the market.
Well, and in the brokers specifically, there was very little sort of giving power to bigger firms in those conditions because the capacity was so prevalent and those relationships were there. Like the leverage that the broker would have in negotiations wasn't really as needed because those deals are good deals and they're making money and there's capital everywhere. When the market hardens, that changes quite quickly, right? And the strength of the bigger firms and the depth of the books that they bring to the market actually carry a lot of weight and a lot of influence. But you're right. So you'd see this influx of new parties and new participants in those soft market conditions.
But I think even in the soft market, they had a huge role to play in driving down those rates, right? If you want a piece of this, well, you're going to have to also take some of that and the other and so on.
Yep.
And it became this real test of relationships, especially towards the end of that soft market cycle, where firms that had been trading on a cedent to reinsurer or broker to reinsurer, cedent to broker kind of style for decades or even generations were faced with the difficult decision of potentially coming off business because the rates had just gotten too low. I remember in Canada, for example, when we had the Fort McMurray wildfires, one of the worst events to affect the Canadian market on the property side for a really long time. Many of the insurers who had massive losses because of the soft market conditions were able to come back to renewals after those events at a flat rate. And all the reinsurers were sat there thinking, we thought we'd get a bit of payback and be able to replenish our losses a little bit given we've just done this massive payout. But the brokers were adamant, no, that's the market conditions. If you want to be on the panel still, that's the price. So it is a tough line for reinsurers that they've followed this for a long time. But things have changed.
Well, and I think on the back of all that, the reinsurers were paying attention to the difficulty that they were having, and they would pay big losses and get flat rate in return. They would constantly be, or every sort of year, couple years, agreeing new, more onerous terms on them, or generous terms to the clients, more coverage for less premium for years and years and years. And there was very little they could do to push back on it besides just not writing deals and choosing not to take the premium income. As interest rates began to rise. You saw a little bit of capital choosing to go elsewhere. You had some very large losses, and then you had a number of the big players like begin to sort of shift where the market was going to be. And obviously, the prices have now moved quite a lot, and some of that third party capital has left. So you're seeing it now where there's a number of factors in the Mike Senzer podcast. We talk a bit about it as well, but there's uh, a lot of power that the reinsurers now hold, and it's not that they're sort of getting back at the market. They're very much trying to position themselves as we need to reestablish what proper pricing is on these deals, which feels like a huge jump. But if you have supply and demand economics in play and you have these other things that are happening, they can say this is what we can afford to do on these deals. And the cedents and the brokers don't have anywhere else really to go besides accepting the terms that are being laid out for them.
And I think it's interesting, right? So what we've mostly focused on so far in this conversation of hard and soft markets has been supply and demand and the extent to which capital is available and willing to participate or is not. But I think in particular over the last 3 or 4 years, arguably, despite my comment at the beginning of the episode, we have seen the risk change in a lot of areas. Things that we thought unthinkable have happened. For example, I think, probably people have heard this hundreds of times for the last, couple of years, but the pandemic, where did that come from? All of a sudden, that's completely changed the world around us, how we operate, where we work and live, and the probability that something that world-changing might happen again. The war in Ukraine, the first war in Europe for generations that shows no sign of stopping and has embroiled all sorts of assets and businesses and individuals' lives in a horribly transformational way to a risk profile. And then, of course, the other big elephant lurking in the room, climate change. You've had all of a sudden the sort of financial world turn around and say this thing that we've been denying for forever and ever and claiming isn't really a thing. Actually, it's a thing that we are acknowledging is real and that we have data on. And actually, it's something we haven't been pricing for historically. So we now need to radically change the way we look at the probability of natural catastrophes. And not just natural catastrophes, by the way. That's the tip of the iceberg. That's the obvious bit sticking out of the water. If you've got radical changes to climate, I mean, we talk a lot about trying to avoid the world going above its 1.5 degree changes, right? We're looking at how much of the world is going to be underwater, in 2050. How much of certain regions are going to be unsustainable in terms of water supply, in terms of businesses being able to operate, in terms of weather conditions that just kill people because it's too hot too frequently for an ever-aging population. The world is arguably riskier. Increasingly urban populations, people still growing rapidly in areas where resources aren't there to support them. It's a different world, and I think the capital providers had enough time during the soft market to realize that they weren't getting the returns from uncorrelated insurance risk to spook them. And now getting them back is coming with the caveat that you better be pricing in for the fact that this is not the world of the happy clappy years that went before.
Well, I think especially with those last few points, you had it where for the last several years, there was a bit of forward looking going, the world is changing. And all of a sudden, I think off the back of some rate changes and some other things, there was this recalibration moment where people go, the world has changed. Right? It's not like it will be, we'll sort of gently move our way towards something else. It's gone, no, it's looking back now and the impact of going. We've had the sort of hurricane data from 1900. And this is, but those 1 in 100, 1 in 250, 1 in 500 events are now like twice a year. And all of a sudden, there's this recalibration of going, and it feels like we will expect it to be of increased frequency and increased severity. And we need to be pricing for that way more aggressive than we have been doing. And because this sort of lurch has happened so quickly, I think you're seeing this this response that, especially if we use like Florida as an example, rate shift that's so high, but now the regulator is scrambling to figure out how they can afford to not have homeowner premiums triple. Um, and that's already a state where homeowners insurance is huge in Florida compared to anywhere else, which it's how the market has to afford that.
Yeah,
So
yeah.
the system has to work. But um, if you already have extortionate homeowners premiums that already require government intervention to help try to keep them at a reasonable level, but the reinsurance now there is also going to go up 40-50%. Like all of this is causing just this knock-on effect that everyone's kind of scrambling about. But yeah, so you're seeing the world shift there, and the prices go quite a step change up from what
And
we expect.
it's interesting how you positioned it as the world has changed
Mm.
rather than is changing. I think that's. I mean, I think I'm writing you having some psychological credentials
Mm.
of your university years, uh, but it feels like our market as a whole is quite responsive to black swan events, world-changing events that change the general perception of uncertainty. Not least because it impacts the money
Mm.
at the source, right? We're an industry that depends on people being willing to give money to us to generate a return. That's even if you're an equity, you know, sort of balance sheet reinsurer, you
Mm.
still need people to believe that reinsurance is a business worth doing for your stock to have value.
Yep.
Or obviously in the sort of third party instruments and so on, that's a bit more transactional, but you're dependent on people believing that the world is a certain enough place for providing insurance and reinsurance to be a sensible thing to be doing. I think we've seen a few events over history that have really challenged those assumptions. So if we look back, there's only one of these every 15 years or so, but 1992 being one where, Hurricane Andrew, I want to say, there we are.
I think that's
Let's just say I was very young at the time.
someone in Bermuda is like, Andrew, you idiot. Yeah, I think it's Andrew.
Yeah, it just changed everybody's entire perception of what damage could be done by a hurricane. 9/11 then, the beginning of the millennium, completely changed everybody's understanding of what could happen to skyscrapers. And that created a whole new market. But for a while, it was like, if that can happen, then anything can happen. We've just seen a pandemic. I think pandemic is probably the most interesting one here because that was so world changing, right? When suddenly we found ourselves locked in our own homes, unable to go out, unable to live normal lives, faced with the prospect of death. The world around that changes everybody's perception for like, oh, okay, how predictable is the world over the next 2 years, 3 years, 5 years, 10 years? And the answer that most people would give now has changed to what they would have given pre-pandemic. And they're getting validation on that position when things like a war in Ukraine happens out of the blue, or when, climate change suggests that everything's going to be very different, when interest rates suddenly start soaring. Ask futurists, as we have previously claimed to be, what they think is going to happen in the world in the next 10 years. And they're like, oh, I can do the next 3 months. But good luck to you. We're sat as well on things like ChatGPT, AI, offering this whole new potential future. We're sat with cyber risk as some giant bubble that's not yet really gone off as a potentially catastrophic event. But I think people are more aware that the unexpected things could happen. Not necessarily will, but could happen at any moment. And it's going to be the reinsurance industry that's potentially sat holding the bill at the end.
Yeah. Well, and we talked about in one of our earliest episodes the sort of what makes reinsurance great, like what is it and where does it sit? And it is that sort of backstop for like economies and society, right? It's the thing that protects everyone afloat, and that value is immense that we provide. But you're exactly right with your last comment is that means that if it all goes sideways, the industry sort of left holding the bill at the end will be reinsurance.
Yeah.
Right? So if we don't get these other things calibrated up front and through it, this is an industry that's set there to be that backstop, but like it's not a charity. and if it sits there and goes, oh my, these are, we can only, hold this position for so long without making sure that we can make sure this is sustainable. So I think it's this recognition in some ways that in this new world that has now existed, it's like if we want to remain as this backstop and this institutional framework that supports everything else, it has to be a case where we can make sure it works and it stays in place. Otherwise, it will be,
Yeah.
a chaotic end to a lot of things. Yeah, when you're watching this all happen out, kind of play out in real time, which it feels because the world paused for like a year and a half. This change has felt very, very abrupt now. And I think the reason it has this sense of drama and panic to it is it was sort of business as usual. A few things we're watching, and it was still slowly evolving. And then it like world paused as like everything went to chaos, and there's all these weirdness where you had like very few motor claims during the pandemic, but like all manner of other things happening quite a lot. And then we've come out of that to a newly recalibrated position, and over the last 2 years now, it's gone very, very different direction. So that feels like a whiplash for a lot of people.
Absolutely. I think it's always interesting to watch the parallels with the venture world as well, right?
Mm-hmm.
Those people watching, startup and technology stocks and things, they've had a really similar sort of weird blend of optimism and pessimism. Initially the pandemic is like, oh, okay, the future world, we don't know if anything's going to exist anymore. Half our investments just beforehand that were super punchy and excited about how this rally of the stock markets was looking. I, up until that point, was like, oh, hang on, the world is now a different place. But then, the world is potentially going to be a different place.
Yeah.
Loads of excitement. And then, maybe not as different as we thought. And then actually at a point now where, admittedly, largely due to inflation and interest rates, again, caused by the same events that we already touched on, people are less excited, I would say, now about the world of tomorrow because they're a little more scared. Hence, would you agree?
I would agree. And the fact you've said that, and I've agreed, as everyone knows, we don't rehearse these podcasts. I feel a bit sad about that, but I think you're spot on, right? I think whilst we have ChatGPT, we have this sort of excitement about what we can do there is a weird forward looking of like, not really looking and talking about like what could happen in 10 or 15 years and the sort of exciting new horizons. And I think there is this aggregation of drama that still exists, or this post-pandemic sort of hangovers that people are still carrying, and everyone's trying to calibrate to new ways of working and hybrid models, and all these things are happening. And you've got, as you said, war breaking out now, and it feels like everyone's kind of in a little bit of a anxious state of let's just live for the next 6 to 12 months and then recognize where we go from there. We'll cross bridges when we get to them. It is a bit of a depressing world we're in at the minute with some of these things.
We'll have to see where it goes. I think nobody, as far as I can remember, I've not seen any projections as to how long they think a hardening market will persist. Typically most younger professionals in our industry won't have seen a real sustained hard market. Because the soft market cycle was so long, and whenever you did have a slight uptick, it was quickly followed by a resumption. Is that a word? Resuming again?
Yeah. Let's use resumption. I like it.
A resumption of the former trend of sort of gradually declining prices. I'm curious to see how long industry commentators think this hardening might continue, because obviously hardening rates are attracting new capacity providers over time. We didn't see the class of 2022 emerge as some people hoped.
Yeah, that was a bit of a surprise from my perspective, as we had commentated previously, but was fully expecting to see sort of at least a handful, kind of like net new. And we didn't get that.
I think that might have largely been just because retro capacity wasn't there to support it either, right?
Possible.
So you would have been going in kind of net.
Which is a
scary initial play
not for the faint of heart.
But I think that is coming back of it now. So we'll see to what extent, I guess, new capacity is able to come in.
And when money when markets start, or pricing starts to harden and deals start to come in, I do think you'll see inevitably that return of capital. Even in a higher interest rate environment, I don't think you'll see the amount of capital that we had when it was zero or negative,
Yeah.
as you said, but it will start to encourage, like, there's still enough there. It's at least worth the diversification across other things. So I do think you'll see a bit more of an uptick.
And I guess what might, again, this is now branching beyond my credentials as an economist, which are non-existent, but the thing that I think we might see is because of because of inflation in particular, we may well see that even where capacity does jump in to accommodate or to take advantage of, the rate rises, it still might not be quite enough to keep up with demand, because demand for reinsurance has shot up as, potential claims costs soar in terms of inflated values of properties, etc. And similarly, that means that every time you add more capacity into the market, it's already been swallowed up by a hungry world of insurers who are a little bit more exposed than they'd like to be right now.
Yeah, we in our Challenges Cedents Face episode, we talked about hypotheticals of like, our clients over-indexed to a certain broker or a certain reinsurer or similar. Is the industry over-indexed to the United States? There's some real inflation movement there, the huge amount of claims there, like, but almost like so much the premium sits there that if more capacity comes into the market, the U.S. risks are hoovering it up. Where you're still like,
I mean, I could not help but answer your question with a question, which is the world over-indexed to the US?
Valid point.
Right, like,
yeah,
I would say yes, but that's with insurance being no exception to the general economy, right?
Sure.
With the dollar, ever since Bretton Woods, there's been sort of a financial system geared around the US, and it is, 50% of Lloyd's business here in London.
Yeah.
It's the largest insurance market in the world, and will be for the foreseeable future. I think we've seen other markets growing to catch up with it to some extent, but it is the heart of the market.
Yeah.
So
when you think about things like inflation or property values, or the cost of repair, and all of these claims, all these things that have knock-on effects in our industry, if it's happening in some of the biggest hotspots in the U.S., it just carries with it this sort of knock-on effect worldwide that you see, which is a bit crazy.
Yeah.
Whew.
It's a dark and scary episode, isn't it? It's like anybody who's listening to this just before they go to sleep, like we said at the beginning of the episode, would be
hopefully they fell asleep
curling up with a teddy bear, like shivering.
They fell asleep during the tangent.
Yeah. Is there a lighter note we can add to this to sort of make the world feel like a happier place going forwards?
We can.
The fact that we almost certainly haven't already missed our climate targets. No, that's not going to be good.
No.
Something must be going well in the world to come. The good news is that anybody who does start a new insurance company, reinsurance company, insurtech, startup, broker, etc., they get the fun of naming their new company for the era to come. So I'm excited to see some new names out there soon.
Well, yeah, and if they follow the naming conventions of other startups, letters and word form don't even apply anymore. You can smash together all manner of chaotic letters and symbols. You can name it like an Elon Musk child.
Yeah.
Which is...
What are they called? I don't know. Is that...
What's the
GDPR?
No, there was what was someone? This is a shouting into the headset moment for some listeners. But Elon Musk named their youngest child something. It was like there's like Greek symbols and things in it, and it was like, what is this word? And
Alpha Musk, Omega Musk,
something like this. No, but it was like an amalgam of English and Greek characters in this sort of... I don't have a thing for Corey to tell me the answer, so...
Oh, he's looked it up.
Oh, it's...
I don't know how to
gracious. So it's X, the AE combo sound, whatever that is. A...
Oh, no. Wait a minute. Hang on. But it's got X's in it.
X,
and he's building X, the Everything app. So his child is named after the...
Yeah, so it's him and Gray.
Oh, okay. This is now a very odd tangent. You are still listening to the Reinsurance podcast if you haven't tuned out, where we talk regularly about the names of celebrities' babies. I can't think of a reinsurance angle on that, except that at a networking event at the Chartered Insurance Institute just yesterday evening, I did meet somebody who had met Elon Musk
Really?
more than 10 years ago when they were first thinking about how they would build rockets.
Yeah.
So, yeah, small world, really.
Yeah.
If you're in space insurance, you get to meet exciting Twitter celebrities.
Well, soon to be former Twitter, I guess.
Yeah.
The company that was previously Twitter resigned to the annals of history at some point.
Indeed.
Oh, what a tangent to end on.
Indeed.
Anything
Well,
any parting wisdom for our?
Maybe you should just click on the next episode, folks, and
just
get this over with.
Just hit next, and we'll see you on the next episode of the Reinsurance Podcast.
Until next time.
Thanks, everyone.